I don't say this lightly. Tomorrow was not supposed to arrive this early. XRP has just crossed from speculation into something far more dangerous, productive capital. And once that line is crossed, the rules around price, time, and patience change permanently. Hello everyone and welcome back to Lion of Crypto. I hope you're having an amazing day. If you're enjoying this content, hit that thumbs up button, make sure you're subscribed if you haven't already, and let's get straight into it. Because what I'm about to walk you through was not supposed to happen this fast. Historically, shifts like this take years, entire market cycles, endless regulatory back and forth. Instead, we're watching it unfold in months, quietly and methodically. While most people still think XRP is just another token waiting on a price pump, that misunderstanding is exactly why this update matters so much. Here's the change that alters everything. The XRP ledger is developing a protocol-level lending system. Let that sink in. This is not a DeFi app duct-taped on top of the network. It's not some third-party experiment running on borrowed trust. This is native to the ledger itself, governed by validators. Fixed-term, fixed-rate lending. Unsecured options, 30 to 180-day durations, and the most important detail that almost nobody is talking about, risk isolation using single asset values. Defaults don't cascade. That's not crypto logic, that's bank logic. This is what institutional credit looks like when it's engineered properly. It transforms XRP from something you speculate on into something you deploy. Yield changes everything. Once yield exists, price develops a flaw. Flaws change narratives. Narratives attract capital, and capital does not wait for validator votes scheduled years out. Markets front-run inevitability. That's why what we're seeing right now matters far more than most people realize. While the broader crypto market bleeds, fear spikes, and headlines scream chaos, XRP quietly pulled in nearly $63 million in ETF inflows in a single day. Bitcoin was red, Ethereum was red, XRP wasn't. That isn't retail enthusiasm. That's reallocation. Smart money doesn't chase green candles. It positions ahead of structural upgrades. This is where most people get it wrong. They obsess over daily price action while completely missing the positioning phase. They wait for confirmation that only arrives after capital has already moved. That's the mistake. Positioning always comes before price. Now, I want to be clear here. This channel is about understanding what's actually happening beneath the surface, not reacting emotionally to headlines. That's why the ETF flows, while impressive, are only part of the story, and honestly not even the most important part. Yes, roughly $1.3 billion has been locked into XRP investment products in just 2 months. That shattered expectations, but the quieter number matters more. $15 billion in payments flowing through Ripple's on-demand liquidity. This is no longer theory. Over 300 financial institutions across 55 countries are involved, with 40% actively using XRP for real settlement, not just messaging. In 2024 alone, on-demand liquidity processed $15 billion in cross-border payments, up 32% year over year. Asia-Pacific accounted for more than half of that volume. Over 70 corridor pairs are now live, covering roughly 80% of global remittance routes. That's not adoption coming someday. That's infrastructure already running. And while all of this is happening, another piece quietly drops that should end the debate altogether. Reports now indicate Ripple is in late-stage discussions for a 2026 IPO. You don't go public if your numbers are fragile. You don't invite that level of scrutiny unless your business is battle-tested. And this is where things start to get really interesting, because once that process begins, the way capital looks at XRP starts to change at a structural level, not an emotional one. And that's what we need to unpack next. Because once that process begins, the way capital evaluates the entire ecosystem shifts. An IPO doesn't just price Ripple as a company. It forces valuation clarity on everything connected to it, including XRP. Institutions care about one thing above all else: models. Once Ripple has a public valuation, analysts can finally model revenue, payment volume, token utility, and balance sheet exposure with real numbers instead of assumptions. Ambiguity suppresses assets, clarity reprices them, and once those models exist, price compression doesn't last forever. Then there's RLUSD, Ripple's US dollar-backed stablecoin, quietly expanding across multiple chains. Ethereum Layer 2s like Optimism, Base, Arbitrum, and others, all connected via wormhole. This isn't wrapped liquidity. This is native cross-chain movement. Regulatory approval from the NYDFS is still pending, but the rails are already built. Stablecoins don't expand unless liquidity is needed. Settlement demand doesn't wait for public understanding. RLUSD feeds the flow. The XRP ledger settles it. Zooming out to the broader crypto market for a moment, not much has changed on the surface. Bitcoin hovering near key levels. Ethereum reclaiming important ground. XRP holding its range around the $2 region, steady, unbothered, total market cap back above $3 trillion. Fear and greed still leaning toward fear, and that makes sense. 2025 hasn't delivered the fireworks many expected. But here's what hasn't happened yet. Rotation. Bitcoin dominance hasn't rolled over. Historically, meaningful altcoin runs don't begin until that happens. And XRP has always been a late mover. When it moves, it doesn't ask for permission. If XRP holds its region and avoids a deeper breakdown, the structural setup continues to strengthen. Liquidity always finds speculative outlets eventually, and when it does, it chases assets that already cross the line from idea to infrastructure. Because what you're watching right now isn't a chart setup, it's a status change, from speculation to productive capital, from narrative to necessity. And once financial systems cross that threshold, price doesn't move gradually. It resets. What makes this moment so difficult for people to process is that it doesn't look dramatic yet. There's no euphoric blow-off top, no screaming green candles, no media frenzy. Instead, it looks boring, technical, bureaucratic, and that's exactly how real system transitions always begin. Financial plumbing changes quietly under fluorescent lights, inside boardrooms, and regulatory frameworks, not on social media. This is where XRP lives now. The market is still trying to value it as a high beta speculative asset, something driven purely by sentiment. But the behavior underneath no longer matches that classification. When an asset starts anchoring settlement flows, credit structures, and liquidity routing, volatility doesn't disappear, but its role changes. Price becomes less about excitement and more about capacity. How much value can this network safely carry? How much capital can it intermediate without friction? Those are completely different questions than how high can it pump. Take the protocol level lending system and zoom out. Fixed term, fixed rate, validator governed lending is not designed for retail degens chasing yield. It's designed for balance sheets, for treasuries, for entities that need predictability, not adrenaline. And the decision to isolate risk at the single asset level is critical. That one design choice tells you exactly who this system is being built for. Banks don't tolerate contagion risk. Regulators don't tolerate cascading failures. This architecture anticipates both. Once lending exists at the protocol level, XRP stops being idle capital. Idle capital is speculative by nature. Deployed capital is productive. Productive capital demands yield, efficiency, and reliability. That's why this shift matters more than any single ETF headline. ETFs validate demand. Lending systems validate utility. And utility has a way of forcing repricing, whether the market feels ready or not. And with that context set, the next layer to examine is how capital behavior itself changes once an asset is no longer treated as speculative, because that phase is where the most aggressive moves tend to originate. Because once an asset crosses from speculative to productive, capital doesn't just flow in, it behaves differently. This is the part most people never think through because it only becomes obvious after it happens. Time horizons stretch. Volatility compresses before it expands. Weak hands disappear, not through panic, but through boredom. And then when price finally moves, it does so in a way that feels disconnected from the charts people were staring at for months. This is where XRP is now. Speculative assets are valued on belief. Productive assets are valued on throughput. How much value can they intermediate? How efficiently can they do it? How reliably can they operate under stress? Once those questions replace what's the next catalyst, you're no longer dealing with a hype cycle. You're dealing with capital allocation. That's why the behavior around XRP feels strange. There's no mania, no desperation, just quiet absorption. ETF inflows on red days. Institutions increasing exposure while retail interest stays muted. Price holding ranges instead of exploding. To impatient traders, that looks like weakness. To long-term capital, it looks like construction. And construction phases always feel slow until the building is finished. When lending, payments, and stablecoin liquidity converge on a single settlement layer, something subtle but powerful happens. XRP becomes harder to replace. Optionality disappears, Switching costs rise. Once institutions integrate a system into operational workflows, they don't casually rip it out because price dipped for a quarter or two. That's not how financial infrastructure works. This is also where the XRP is centralized argument quietly collapses under its own weight. Institutions don't adopt systems despite governance. They adopt them because governance exists. Validator voting, risk isolation, protocol-level rules. These aren't weaknesses. They're prerequisites. They're the difference between experimentation and production. And production systems don't reprice incrementally. They reprice in steps. Think about how markets revalue anything once uncertainty is removed. Court rulings, regulatory approvals, mergers, IPOs. Price doesn't politely drift higher over years. It gaps, it jumps, it resets to a new range, and then people argue afterward about whether it was obvious in hindsight. That's the phase XRP is approaching. The IPO discussion matters not because it's exciting, but because it forces convergence. Private valuations, public disclosures, analyst models. All of it collapses speculation into numbers. And once numbers exist, capital doesn't argue emotionally. It arbitrages inefficiency. If XRP's settlement role and utility volume are mispriced relative to Ripple's valuation and payment flows, the market corrects that imbalance fast. This is why timing these moves is so difficult. The biggest repricings don't come when everyone agrees. They come when enough players independently reach the same conclusion and act without waiting for confirmation. That's when liquidity thins, bids stack, and price moves faster than narratives can keep up. Now add macro liquidity back into the picture. Stimulus doesn't care about narratives. Tax refunds don't analyze white papers. Liquidity flows into assets that can move and appear undervalued relative to their future role. That's why late cycle rotations feel chaotic. Capital isn't patient, it's opportunistic. XRP sits in a strange but powerful position in that environment. It's liquid enough to absorb size. It's regulated enough to be permissible. It's boring enough to be ignored until it isn't. Historically, XRP's biggest moves have happened when conviction was lowest and attention was elsewhere. Not during peak optimism, but during disbelief. When holders were exhausted. When commentators called it dead money. Those conditions are quietly forming again, but with one critical difference. The fundamentals are orders of magnitude stronger. Back then, XRP was a promise. Now it's a pipeline. Pipelines don't need hype. They need flow. And once flow reaches a certain threshold, valuation follows whether anyone likes it or not. Markets can ignore reality for a while, but they can't ignore it forever, especially when that reality shows up in balance sheets, settlement volumes, and audited disclosures. That's why this moment feels heavier than past cycles. It's not just about potential. It's about role finalization. XRP is no longer auditioning. It's already been cast. The only open question is how long it takes the market to fully internalize that shift. And here's the uncomfortable truth most people don't like to hear. By the time consensus forms, the opportunity phase is usually already over. The easy asymmetry disappears. Risk to reward compresses. What was once debated becomes assumed. That's when people say, "I always knew," even if their positioning said otherwise. Tomorrow doesn't mean a green candle. It doesn't mean fireworks on the chart. It means a classification change. From speculative asset to productive capital. From optional exposure to modeled allocation. From narrative to necessity. Once that line is crossed, there is no rewinding the tape. That's why the current boredom matters. Sideways price action matters. Doubt matters. Those are the conditions that precede structural repricing, not the ones that follow it. Markets don't reprice assets when everyone feels comfortable. They do it when conviction quietly builds under the surface while attention is elsewhere. This is also why comparing XRP's trajectory to previous crypto cycles misses the point. In past cycles, infrastructure followed price. Projects raised capital after speculation drove valuations higher. This time, infrastructure is arriving first. Usage is expanding first. Capital markets are integrating first. Price is lagging fundamentals, not the other way around. That inversion is deeply uncomfortable for people conditioned to fast gratification. But it's exactly what you would expect if digital assets are maturing into financial infrastructure rather than remaining casino chips. When systems mature, the signals change, noise fades, data starts to matter more than sentiment. Zooming back to RLUSD for a moment, the multi-chain expansion is another signal many are misreading. This isn't about competing with other stablecoins for retail attention. It's about liquidity orchestration. Stablecoins are the grease that allows value to move efficiently across systems. By positioning RLUSD across major layer 2s while settling through the XRP ledger, Ripple is building a liquidity mesh. Value enters where it's needed. It settles where it's cheapest and fastest. That isn't accidental. That's systems thinking. And systems thinking is what separates platforms that survive from those that spike and fade. Markets eventually reward architectures that reduce friction across multiple layers. Payments, credit, settlement, compliance. XRP keeps checking those boxes even when the price chart looks unimpressive. That disconnect is what creates opportunity before repricing occurs. Now bring it back to broader market psychology. Bitcoin dominance still hasn't rolled over. Historically, meaningful altcoin expansions don't begin until that happens. XRP has often been a late mover in those rotations, frustrating holders right up until the moment it isn't. But here's the key difference this time. Even without a full rotation, XRP is attracting capital. Not euphoric capital, strategic capital. The kind that doesn't leave at the first sign of volatility because it's tied to long-term infrastructure theses. That's why holding key structural levels matters more than chasing short-term upside. If XRP continues to hold its range while fundamentals compound underneath, pressure builds, compression builds, and eventually that pressure releases. Not because of hype, but because the market runs out of reasons to price it like a question mark. None of this guarantees a straight line. Markets never work that way. But it does change the probability distribution. Downside becomes harder to justify structurally. Upside becomes easier to model. And when enough participants reach that conclusion independently, price moves faster than anyone expects. This is how transitions actually happen, not with fireworks at the beginning, but with quiet switches flipping behind the scenes. Lending rails go live, payment volume scales, regulatory clarity hardens, valuations become visible, then almost suddenly, the market realizes it has been looking at the wrong thing the entire time. And by the time that realization becomes consensus, repricing is already underway, because by the time consensus forms, markets have already moved on. This is the phase that feels the strangest, where nothing looks broken, but nothing looks exciting either. Price drifts, volume compresses, attention shifts elsewhere. And underneath all of that, positioning quietly completes. This is not financial advice. It's an observation about how capital behaves once an asset is no longer treated as a question mark. Once XRP crossed from speculative exposure into productive capital, capital didn't stop flowing. It slowed down, stretched its time horizon, and became selective. That's the signal most people miss. Speculative assets are driven by belief. Productive assets are driven by throughput. How much value can they intermediate? How efficiently can they do it? How reliably can they perform under stress? Once those questions dominate, price discovery stops being emotional and starts being mechanical. That's why XRP's behavior feels disconnected from what many traders expect. ETF inflows during red days, institutions adding exposure without fanfare, price holding structure instead of chasing momentum. To short-term eyes, that looks like stagnation. To long-term capital, it looks like absorption. And absorption is always boring until it isn't. Construction phases feel slow because progress isn't visible from the outside. But once the structure is finished, repricing doesn't ask for permission. It happens quickly, often violently, because liquidity was already positioned. When lending, payments, and stablecoin liquidity converge on a single settlement layer, XRP becomes more than an asset. It becomes harder to substitute. Optionality disappears. Switching costs rise. Institutions don't casually unwind infrastructure decisions because of short-term volatility. That's not how balance sheets work. This is also where the old narratives finally lose relevance. Arguments about centralization, governance, or control sound loud online, but they fade in boardrooms. Institutions don't adopt systems despite governance. They adopt them because governance exists. Validator oversight, risk isolation, protocol-level rules. These aren't flaws, they're requirements. Production systems don't reprice gradually, they reprice in steps. Think about how markets react when uncertainty is removed. Court rulings, regulatory approvals, IPOs, mergers. Price doesn't drift politely higher, it gaps, it resets to a new range. Then the debate shifts from if to why didn't I act sooner? That's why the IPO discussion matters. Not because it's exciting, but because it collapses ambiguity. Private assumptions become public numbers. Revenue becomes modeled. Utility becomes measurable. And when inefficiencies are visible, capital arbitrages them without emotion. Layer macro liquidity on top of that, and the setup becomes even more asymmetric. Stimulus doesn't care about narratives. Tax refunds don't read white papers. Liquidity looks for assets that can move and appear mispriced relative to their future role. Late cycle rotations always feel chaotic because capital isn't patient, it's opportunistic. XRP sits in a rare position in that environment. It's liquid enough to absorb size, regulated enough to be permissible, boring enough to be ignored until it isn't. Historically, its largest moves have happened during disbelief, not euphoria, when conviction was lowest, when attention was elsewhere. The difference this time is fundamental. XRP is no longer a promise. It's a pipeline. Pipelines don't need hype, they need flow. And once flow reaches a critical threshold, valuation follows whether the market likes it or not. Markets can ignore reality temporarily, but not indefinitely. Not when that reality shows up in settlement volumes, balance sheets, and audited disclosures. That's why this moment feels heavier than past cycles. It's not just about upside. It's about role finalization. Tomorrow doesn't mean price action, it means classification, from speculative asset to productive capital, from narrative to necessity. Once that line is crossed, there's no rewinding the tape. So enjoy the boredom, enjoy the sideways price action, enjoy the doubt. Those are the conditions that precede structural repricing, not the ones that follow it. Hit the thumbs up if this helped frame what's really happening. Make sure you're subscribed to Lion of Crypto and turn on notifications so you don't miss what comes next.